Fami, you should be good to take over the monitor. Let me know if you have any issues. So Joseph Fami, guys, friend of mine, and to me, I think the presentations that he gives with respects to the power of relative strength in order to really find the next big move, I think is spectacular. I don't know anybody who does it better. Fami, can you hear me?
Yes, I can. Can you hear me?
I hear you loud and clear. Joe, I'm not sure if you saw Greg Schnell's presentation earlier. He was showing the audience a filter called the Scooter to essentially scan for stocks showing a combination of momentum and relative strength, right? So for audience members, I think that's a great starting point. It's a great way to see what sectors are strong, what stocks are strong. But then from an execution standpoint, I think Joe Fami is the perfect sort of a way to follow up on Schnell's presentation, because Joe is going to show you how really he uses that relative strength for execution purposes. So Joe, do your thing, man.
Okay. Let me just hide the thing on the bottom. Just to, you can see everything okay, or?
We can see you perfect. We can hear you. You're ready to rock, man.
Okay. Give me 1 second. All right, cool. And you can see it's a PDF I have up here. You can see it okay?
We see it perfect. You're
okay.
So technologically advanced, Fami.
No, I was having problems with my computer. I had to reboot it, so sorry about the delay. Anyway, I just wanted to first start off by thanking you, JC, for putting together this amazing event. I think it's a big compliment to you for not only the network of people that you know, but to get them, it shows a lot of respect to you that you got everyone together. Some really, really great people in our community. So thank you for that. I also want to thank everyone for listening in, and depending on where you are in the world, it's there's a lot of things you could be doing on a Saturday morning, afternoon, evening, depending on where you are, and I respect you guys for being here. There are one trait of successful people is the ability to improve and always looking to improve yourselves, and I think by attending this webinar, you are instantly showing you have a common characteristic with successful people looking to improve your trading, improve your technical analysis, and improve your skills. So, a big thank you for everyone tuning in. So, let's move on to, I'm going to do a quick introduction, discuss my definition of relative strength, give some examples from the past 20 years, and you can always email me if you want this will also be archived, but if you want a PDF version, this is what I have here of the slides. Quick introduction. My name is Joe Fami. I am a money manager with a firm called Zor Capital, New York-based investment management firm. I've been trading for over 20 years. I have a extensive amount of knowledge with technical analysis, market forecasting, risk management, some fundamental work as well. I grew up in Boston, went to Tufts University, where I majored in economics and religion. A lot of people ask me, did you do that so that you pray to make money? And that's exactly what I do. That's my strategy. I pray that I make money. So, and then I blog frequently at joefami.com as well about the markets and post videos there. Now, I've done all-day seminars where I go over my general philosophy, go over 4 signs of a healthy market, go over my screens, fundamental, technical, characteristics of winning stocks, and so forth. But the reason I chose to discuss relative strength, which is down at the bottom here, because I could talk all day about the market, but the reason I chose relative strength is because it applies to everybody out there. I don't know if people out there are day traders, swing traders, longer-term investors, but the tools I'm going to show you for relative strength apply to no matter who's out there with your time frame, and hopefully no matter what your time frame is, you'll get something out of this. So just quickly, my definition of relative strength is stocks showing strength relative to the market. So when I talk about relative strength, it's not RSI, it's not any sort of technical indicators, and I'll show you in a minute what I mean by that. This is strictly a simple definition. I want to keep this as simple as possible. I'm looking for stocks showing strength relative to the market. In other words, when the market is going down, I want to look for things that are holding up well. Okay, and it's just, and I'll show you exactly what I mean when I get through several examples. And the reason I put this chart up is a lot of us have real-time quotes or have apps on our phones with red and green arrows, or Yahoo Finance, whatever free sites that you use, where you're going to have your stocks and indexes, ETFs, and so forth with red or green arrows. I want to look for the stuff that's green on a day where the market is red, whether it's a 1 or 2 day pullback, a few week pullback, or even a longer correction or bear market. I want to look for the ones that stick out when you have your real-time quotes, the ones that stick out as green and consistently green in a sea of red, so to speak. So I got fascinated by this when I first started trading. I feel old because it was over 20 years ago, but I did really well. One of the first stocks I did really well on was Yahoo back in 1997, 98 into 2000. And from when I first started trading Yahoo, it went on to a huge, huge gain. So what I wanted to do is look at what it looked like before Yahoo went on to a big gain. So give me 1 second. I'm just fixing something here. So what I'm saying is I wanted to look at what Yahoo looked at before that. So let's look at what it looked like before it went on to a big gain. So on the bottom here, I have a chart of the NASDAQ composite. You can use the S&P, you can use Dow, whatever. I just like to use the NASDAQ because it's the leading index. And I overlaid on top a chart of Yahoo before it went on to a big gain. And you can see here in the summer of 98, there was a correction, long-term capital blew up, there was a Russian debt crisis, and you can see in the first leg down here, the NASDAQ corrected and Yahoo had a leg down. Now look at the second leg down. We made a lower low on the bottom in the NASDAQ and Yahoo barely corrected and it just held up there. And this goes to my definition of relative to the market, I'm looking for stocks showing strength. In other words, when everything is getting decimated, I'm looking for something holding up. Think of it as they say, a beach ball underwater or a spring. If you compress a spring with your hands, the second the tension is relieved off of the spring, these stocks that are showing strength during corrections tend to move higher. It's not automatic. You just have a higher probability. In other words, if the market's getting crushed and a stock or an ETF is holding up well, most likely when the market's done getting crushed, it'll move on to new highs or recover stronger than the market. In other words, it's just waiting and buying time, waiting for the correction to end. Okay, Mr. Market, when you're done with this pullback or correction, I'm ready to go higher. And I think what creates this strength, as you can see on the right hand of the screen, is the big institutions that control the markets. It's not you or me buying 100 or 1,000 or even 10,000 shares that's going to hold a stock up. It is the big pension funds, mutual funds, and hedge funds that are buying hundreds of thousands, if not millions of shares that are holding up stocks. I'll give you an example. A good friend of mine is one of the top traders at Fidelity. And when the money managers come to him and they say, buy shares, they're telling him buy 3 million, 5 million, 10 million shares of this stock over the next few weeks. And then I joke with him. I said, well, can you call me before you put in those trades? But I know that's just a joke. But what I mean is they tell him you got to buy an insane amount of shares and just do a good job with it. Meaning, even when the market's getting killed, there are big institutions that need to get in stocks. They can't only buy on the up days. They need to buy on the down days too. And that's what helps support the stock. And from this level, you can see Yahoo from this point went on to over a 700% gain in 15 months. And the reason, as I said from the beginning, why I chose to discuss relative strength is because if you are a day trader, if you are a swing trader, or if you're a long-term holder, you can see from this point here, after the market was done correcting, whether you wanted to day trade it short-term, swing trade it for a couple of months, or hold it longer term. Again, I don't know everyone's time frame out there, but no matter what your time frame, these are high probability trades, no matter how long you want to trade them for. Another example is Broadcom. I'm going to take you through a whole bunch of examples here. You can see here, again, just to show you, on the bottom is the correction we had in the summer of 98 in the market. When the market bottomed in October 8th of 98, it's so sad that I remember these things from 20 years ago. I don't even remember what I had for dinner last night. But when the market bottomed, you can see the NASDAQ made a lower low, but Broadcom made a higher low. This was still continues to be a strong chip company, but at the time was an explosive growth company. And from this point of when the market bottomed, this is the arrow on the left is when the market bottomed, the stock went up over 1,500% in a year and a half, proving once again, whether you want to day trade this, you want to swing trade this for a few weeks, a few months, if you want to hold this longer term, that's up to you and your definition and your strategy and your time frame. I'm just trying to show you higher probability names that you have higher probabilities by using this, this technique of stocks holding up well relative to the market. Just a quick comment about technicals, because I know that I'm preaching to the choir. There are a lot of people out there that love technical analysis and are learning how to read charts. There are a lot of people I talk to who think that chart reading is hocus pocus, and they think it's garbage. I'm sure JC and a lot of the CMTs out there hear this a lot, that it's all garbage. But I totally disagree with that. When you go to a doctor and you are getting an analysis, whether it's an X-rays or an MRI or EKGs, what are those images that he's putting up on an imaging screen, whether it's an X-ray or whatever? Those are charts, essentially. They are charts that are determining your health. You go to a doctor, he's got an EKG, it's a chart that's going to determine your health. My analogy is that when you have to learn how to read charts, because charts are going to give you an indicator of the health of a stock, of an ETF, of the overall index. That's why if you get one lesson from this, learn how to read charts, because charts will give you the health of a stock and give you the health of a market. That's why it's important to learn how to read charts and do your due diligence. Now, a few points I want to make is you have to pay attention during corrections, especially embrace corrections. The market's going to give you clues. A lot of people say, well, how do I find all this stuff? And I hate to sound so simple. It's just pay attention. In other words, the market's getting crushed, and you want to embrace those corrections and look at the clues. Remember what I said about the red and green arrows. Look for the stuff that's holding up well and that's green. And don't argue with the market. So many people say, the market's going down. Why isn't this stock getting killed? Don't argue with that. Embrace that. There are two things I never argue with: the stock market and women, because they're both smarter than me and they're both always right. So that's another. Who thought you'd get market advice and dating advice in the same in the same webinar? But
I love it, Bobby. I love it. I love it.
So don't argue with the market or with women. So that's simple. Let's move on. I said from the beginning, and I know I have to be respectful of the time because there's a lot of great speakers, and I want to leave time for questions from JC. So I want to go quickly through examples. We started with 98, with long-term capital, Russian debt crisis correction. That's around the time when I first started trading. Let's move forward now to 2000, which is the dot-com collapse. On the bottom, I am showing you the NASDAQ composite after the dot-com collapse in March, April of 2000. The NASDAQ, this is a daily chart, by the way, on the bottom. Just think about this concept. The NASDAQ dropped 35% in 17 days, roughly. So imagine if an index dropped 30. I mean, we dropped 10% last year in January, February, and people were ready to jump off of buildings. This is just a reminder that when the market does correct, you have to be respectful of that. The market got annihilated when the dot-com bubble collapsed in 2000, and at the top was Panera Bread. And Panera Bread is not only was holding up well and showing strength, it was making new highs, which is amazing. So you can see here, it showed amazing strength relative to the market. That's what I say by just pay attention. The market's getting crushed, and you're saying, what is this stock that's making new highs every day? And from that point, it was a recent IPO, and split adjusted, the stock went from 4 to over, I think it's over 200 now. This might be an older, actually a lot of these slides might be a little bit not up to date with the pricing, but you can see the point. Whether you're a day trader, swing trader, or a longer term holder, this gave unbelievable clues when the market was getting crushed and this thing was doubling. As I showed you here in the slide before, split adjusted, the stock went up 50% when the market went down 35%. So that's another example from 2000. Moving on to September 11th, 2001, obviously a horrible day for our country, but the reason I put up this slide is this is exactly what I was talking about. I had about 70 stocks on my watch list, ETFs, everything, indexes. Every single thing was red. Every single arrow was red on my charting software except for one stock was green, and that's Whole Foods Market. And you can see here on the bottom, hopefully you're all following, on the bottom is a daily chart of the NASDAQ, and the market was closed Tuesday morning when that happened, was closed for 4 days, reopens Monday the following week after 9/11. Market gaps down huge. I think the Dow was down 600 or 700 points, and Whole Foods was green on that day. It's the only one that was green on my entire screen. Everything got annihilated except for Whole Foods. From this point, even though we were still in a bear market until late 2002, early 2003, from this point, Whole Foods went up 400% in 4 years. Again, whether you are a short-term trader, whether you are a swing trader or a long-term investor, the market gave you clues when everything was getting crushed with the stocks that were holding up well. Once again, for the people who joined late, the definition I'm using of relative strength is not RSI. It's not any indicator. It is strictly a visual thing. I'm looking at stocks showing strength, holding up well relative to the market during corrections and pullbacks. We're going to, for the sake of time, I want to fast forward through, we talked about 98, we talked about 2000. When we went through a 3-year bear market from March of 2000 to March of 03, that was a really long bear market. And same thing, there's so many examples I put on the bottom. You can go look at them. Taser, Cena, SanDisk, which I believe was bought out, Netty. Some of these are actually still making new highs. Hansen, which is Monster Energy, that stock was up 20,000% since 03. But the same thing, if you go back and look at those charts, when the market was making lows, those stocks were also holding up very, very well. Similar thing. So you can take a look at that at your leisure. An important point about leaders. A lot of people ask me, follow the leaders. Have you heard that expression? Pay attention to the leaders in the market. Leaders tend to make highs as the market bottoms, sometimes on the same day or within a few days. That's why you want to watch the new high list. In other words, when the market is bottoming is when a lot of leaders within the same day or a few days of the lows, those are your leaders. In other words, like I said, think of the beach ball underwater or compressing a spring. The second you relieve the tension off of that spring and the market tends to bottom, these stocks are on the new high list, which is why you want to watch the new high list. Let's fast forward to 2009. As again, I'm taking you through history for the last 20 years. On the bottom, again, hopefully you're following and I'm not just rambling on too much, but on the bottom is the March of 2009 financial crisis, from 08 into 09 when we bottomed. And on the top is Netflix. And you can see the same thing here. When we made the low on March of 09, in early 09, Netflix was one of the first stocks to make a new high. So you can see on the bottom here, as it got killed, that's why the line goes across here. It was just holding on and buying time until the market bottomed. The second the market bottomed, Netflix was one of the first stocks to make a new high. And you see from here, now this slide is definitely not updated because I show from the high here, split adjusted, 40 to 300. Split adjusted, it's actually 1,000 because the stock's trading around 140 and it's a 7-for-1 split. So this really, if you take out the split, went from 40 from $40 a share to close to $1,000 a share. So from the March of '09 low. This was one of the first stocks to make highs, showed incredible relative strength, and was a huge clue the market was giving you that it was going to be a leader. Quick trivia question out there before I go to the next slide. If you remember in the financial crisis of '09, everything got crushed. Energy, financials, all down 60, 80, 90%. What was the first stock, not to make a 52-week high, but the first stock coming out of the 2009 low? What was the first stock to make an all-time high? And I'll give you a hint. You can think about it for a second. The first stock to make an all-time high coming out of the '09 low is coffee-related, and was Green Mountain Coffee. And this is the slide of Green Mountain Coffee. Same thing. On the bottom, we have a daily chart of the NASDAQ Composite, and Green Mountain Coffee, when it made the new high in March, was not a new high, 52-week high, was an all-time high. That is, I don't know what is a more screaming definition of relative strength than the first stock to make an all-time high coming out of a market which got crushed 40 to 50%, and a lot of energy and financials got crushed 80% or more. This was the first stock to make an all-time high. As the market started to climb up, you can see on the right there, the market started to climb up. It held up very, very well. They announced Green Mountain Coffee not only makes the K-Cups, they make the Keurigs. They've been bought out since then, and they're private, but they announced that they were going to do a distribution deal with Walmart, and the stock took off from there to start distributing their Keurigs in Walmart and so forth. So this was back in '09. Seems like a long time ago, which it was, but it's an amazing move. Again, whether you're a day trader, a short-term trader, or a longer-term investor, this stock went, I think, from split adjusted from 10 to 110, went up huge since the March of '09 low. I want to fast forward to some more examples. I want to discuss relative weakness, the opposite of relative strength. Here is an example going back to the March of '09 low of Myriad Genetics. I remember buying this stock, and the stock made a new high coming out of the March of '09 low, and I was thinking to myself, this is amazing. I nailed it. I'm going to nail a huge winner right here. I was instantly at a profit, went from 40 to 45, and everything was looking good. Now look at the right side of the screen. The market kept climbing from March of '09, and all of a sudden this broke its 50-day, broke its 200-day, and really started to break down. I got stopped out when it broke through its 50-day, and you can see here from this point of the March of '09 low, it was down over 50%. So I really, really want to stress a point here. This isn't automatic. In other words, going back to Myriad Genetics, it made a new high, but you still have to use stops. You still have to have some risk, some discipline in there and some risk parameters. So the important point about leaders, just to review, leaders tend to make highs as the market bottoms, sometimes on the same day or within a few days. That's why you want to watch the new high list, but this is not automatic. You still have to have some risk controls, like with Myriad Genetics, saying, oh my God, this is a stock that just made a new high, I'm going to nail a big winner, and then it broke down, which is why these are high probability situations, but you still have to use stops and some risk control. I'll try to fast forward through some more examples. The flash crash of 2010 on the bottom happened in May of 2010, and we had a 3 to 4 month correction in the summer of 2010. Spreadtrum Communications, which has been bought out since, similar to Panera Bread. The market got crushed, and Spreadtrum was making new highs. Notice something here, and I'll give you a second to think about it, on the right side of the chart. Notice something. Does anything stick out to you on the right side of the chart? On the right side of the chart, on the bottom, was the day the market bottomed, early September 2010. Bernanke announced QE2 at Jackson Hole, and the market bottomed there. And as the market bottomed, Spreadtrum made a new high, came out of a cup and handle base and broke out to a new high. Going back to my point, leaders tend to make highs the day the market bottoms or within a couple of days of the market bottoming. From that point, the stock went up 120% in 5 months. So you can see it showed amazing strength relative to the market, which was in a correction. Same example on the bottom, same thing, flash crash, correction in the summer of 2010. Acme Packet, which I believe was bought out by Cisco, same thing, just kept making new highs. Any tension relieved off the market, it went higher. The market would drop, it would just buy time. Then any tension was relieved in that summer correction, it would go higher and make new highs. When we finally bottomed early September 2010, the stock doubled in 5 months. And again, the market gave you clues during the correction, which is why you want to embrace corrections. I know it feels like we've never had a correction recently, but it will come. It'll shock a lot of people at some point. And when it does come, don't run scared and don't fear. Use it and embrace it to find these clues that the market's giving you. Fast forward to a more recent example, October of 2014. We had a pretty decent sell-off in the market, and Qualys, which is a database company, enterprise software. You can see here on the bottom, just look at it visually. You don't need any indicators, you don't need anything. The market corrected, and it just went sideways. The second we relieved the tension of the market, it went on for a 60% gain from there. Receptos, which I believe was bought out by Celgene, a biotech company. We were involved in Crohn's disease and didn't even have any revenues, didn't even have any earnings, just waiting on phase 3 drug trial. What's amazing about this is when the market takes a hit, as you can see on the bottom there, usually people dump their riskiest and higher PE assets. In other words, they'll dump the Netflixes of the world and the higher Amazons of the world, and they will buy your Staples, your McDonald's, your Walmarts, your Procter & Gamble's. What's amazing is you would think when the market's getting hit, they would dump a biotech stock, which has no earnings and no sales, and it's a speculative name. And I remember being in this stock and saying, wow, I was really expecting the market, this thing to take a hit. I actually added to my position as the market bottomed. They came out with positive phase 3 drugs, and the stock went on, and I think Celgene bought them out for $2.20 a share or something like that. But again, it showed amazing relative strength during the correction in the market. AmerisourceBergen, another one, symbol was ABC. You can go back and look, same concept, just went sideways while the market took a hit and went on to a 30% gain, fairly large cap company where you could have had, with a lot of liquidity in there. Going back to my definition of stocks showing strength relative to the market. A lot of people ask me tools to find relative strength. I mentioned paying attention. I know it sounds simple, but you have to pay attention to what's going on. The new high list, especially on down days and around market bottoms, pay attention to the new high list. You can use screening tools, free ones. I use MarketSmith. Telechart's also great if you want to pay for great service. FinViz is free. Yahoo and Google Finance. You can just Google market screening tools and you can get some free ones, but FinViz is great if you're just looking for a free one. So use screening tools to look at charts. As I said earlier, learn how to read charts and pay attention to the stocks that are holding up well relative to the market. Before I go into questions with JC, I want to leave you with a couple of trading tips. Hopefully you can get something out of this. This isn't a joke to me, folks. This is, I know I like to joke around on the stream and have fun, and I enjoy, and I'm very passionate and love what I do. However, you have to work at this to go out and learn how to golf. You can go buy clubs, rent clubs, go to a course and play golf. That doesn't mean you're going to be good. You have to work at it. In other words, to get out there and golf is really not a big barrier to entry. To get out and trade, there isn't a big barrier to entry. In other words, you can, from your phone, send money to an E-Trade or Ameritrade account and start trading on Monday. That doesn't mean you're going to be Warren Buffett. So just because trading and the access to trading is easy, it doesn't mean that you're going to do well. You have to work at this. You cannot dabble. You want to be a master of this. You want to develop a methodology. You want to develop a discipline. You want to do post-analysis of your trades. I really, really feel the stronger I work at this, the stronger I'm adapting to the market and looking to correct mistakes, the better you do. You really do have to work at this. If you're looking for advice, I'm always a big fan of the expression success leaves clues. Study success. If you want to lose 20 pounds, study someone who just lost 20 pounds and learn from them. Same thing with the market. If you want to be a trader, you want to be an investor, depending on your style, study someone who has been successful at the style that fits your personality. In other words, in these Market Wizards books, and there's a couple more that have been out since then, but they are interviews with the top traders. You want to learn how to be a great trader, read about William O'Neill, Paul Tudor Jones, Ed Seykota, and the original Market Wizards, some amazing traders in there. You want to learn about long-term fundamental investing, read Peter Lynch. You want to learn about value, read Warren Buffett. Whatever fits your personality, find someone who's successful at that strategy, and don't reinvent the wheel. Just mimic it with your own flavor. It doesn't mean you have to copy them exactly, but mimic them with your own flavor. I have this on my website. I'd be happy to send it to anyone as well. Recommended reading list. I'm a huge fan. The first three is really all you need, in my opinion. There's tons and tons of great books out there. How to Make Money in Stocks, William O'Neill. Go through the first 100 pages, and that is the best you're going to learn on how to read charts. They're all annotated. Just go through the first 100 pages and How to Make Money in Stocks. Tons and tons and tons of great charts throughout history there. How to Trade in Stocks, Reminiscences of a Stock. You ask anybody, almost everyone will tell you one of their favorite books is Reminiscences of a Stock Operator. Mark Douglas's books are amazing for mental toughness. 80% of trading is mental toughness and getting your mind straight, and it really, really helps with that. Victor Sparandeo has great technical analysis books. How I Made $2 Million in the Stock Market. It's a funny title, but it's a great book by Nick Darvis. If you ever want to write a book, by the way, on the stock market, title it How I Made $3 Million in the Stock Market, because you'll sell more than the $2 million. In other words, if I'm at the bookstore, I want to find out how the guy made $3 million, not how the guy made $2 million. It's kind of like Something About Mary. You want 7-minute abs, not 8-minute abs. I want, that's going to beat that book out in sales. I mentioned the Market Wizards books, and then the mental toughness. I talk about confidence and emotional control are extremely helpful to become a successful trader. Think and Grow Rich is one of the best trading books you'll ever read. It has nothing to do about trading, but has to do with mental toughness. Wayne Dyer and Tony Robbins have great, great books on mental toughness, which I believe is 80%. I don't care what your strategy is. If your head's not straight, you will not succeed, period. So you have to be mentally tough as a trader and as an investor. Second tip I will leave you with is cut your losses. This is an actual chart. It says company XYZ, but it's an actual chart in 2000, 2001 of a company that went from 20 to 90. And a lot of people had a lot of their retirement in this, and this was touted as analysts had $300 and $400 price targets as one of the biggest winners to come, and a lot of people were convinced that this was going to be a monster stock. You can see on the right-hand side, there's on a weekly chart, a lot of volume came in and selling volume, which is why, again, you have to learn how to read charts, learn how to read price and volume. And it started to break down. And anyone want to take a guess what this is? I'll give you 10 seconds before I move on. This was a stock that ended up being Enron. And you can see here the time of the key sell signals at the top. This turned into Enron. That's why it's important to cut your losses and protect your confidence. There's plenty of examples, WorldCom, CMGI, Lehman, Bear Stearns, but all it takes is one of these stocks to ruin your year, ruin your portfolio, and crush your investing morale. That's why you got to protect your confidence and cut your losses when you see heavy institutions coming in and selling stock. Another reason to cut your losses is a lot of people understand this math, but they don't really think about it. If you lose 10% on the left, it takes 11% to get back to even. But if you lose 50%, it takes 100% to get back to even. The larger your loss, the larger the gain is required to break even. Think about it. If you have $100 and you lose 50%, you have $50. It takes you a double, 100%, to get you back to your $100. That's another reason you want to try to contain your losses. So, in summary, protect your confidence, stay focused on the positive, cut your losses, have a plan. You got to work hard at this, learn how to read charts, cutting the losses, protecting capital, because the goal is to be consistent. I'll leave you with this. Michael Jordan is not one of the best players to ever play basketball because he scored 30 points once in a game. It's because he consistently averaged 30 points a game over the course of a 15 or 20-year career. Paul Tudor Jones is not one of the best investors, hedge fund managers, traders out there in the history of the world because he made money one year. He consistently has been profitable over the last 20, 25 years, and there was a stretch of like 23 years he didn't have a down year. So that is the goal. You want to be consistent. You don't want to be a boom and bust trader where you make a bunch of money and give it all back. You want to be consistent, and this is through having a plan and protecting capital and really, really protecting your confidence. And it sounds a lot easier than I'm making it out to be, but it really does involve a lot of work, but it's something you have to consistently work at. I will leave some time for, how am I doing on time, JC? I'll leave some time for Q&A.
Fami, you're the man. I mean, this is just such a fantastic presentation. I mean, people people on the chat are saying how great it is, and how much they're loving this presentation. So first of all, thank you. A few points that you made that I want to reiterate. First of all, if you could just go back real quick and pull up that slide, another reason to cut your losses, where you're showing how much money you need to make based on how much you lost. So guys, this slide right here, when it comes to risk management, I mean, this is it. Print it out, put it on your wall, frame it, this, right, Fami? I mean,
I have it tattooed. I have it tattooed on my right arm next to the Yellen tattoo.
Oh my God, hilarious. Another point that you made that I think that I want to reiterate is the mental toughness. Phil Perlman, who's a doctor in psychology, last night, we were just having a nice fireside chat, and that's one of the things that he was really reiterating. Not that the mental toughness and being not just in mental shape, but in physical shape too, and making sure that your body and mind is where it needs to be, so that
Absolutely.
you can perform to your highest ability, right?
Yeah, it's funny you mention that, because I know there's some people out there who I'm a big Tony Robbins fan, and he personally coaches people for over $1 million a year. And he tells you, let me give you some free. A lot of us can't afford that, obviously. So he says, let me tell you the first thing I do when I coach people. I don't care if they're athletes, politicians, traders, businessmen. The first thing he tells them is get your ass in shape. So that's $1 million of free advice. He says, I don't care what you're doing in your life, but Phil is awesome, by the way, with the mental toughness and the psychology. I always have amazing conversations with him about this stuff. But he is absolutely right, and I'm glad you reiterated that point. Staying in shape really, really helps with that mental toughness. And you'll see that from one of the traits of the most successful people is first thing in the morning that they list is working out, not only to get it out of the way, but to stay in good shape and stay mentally tough.
And Joe, let me ask you this. So, I love all of your examples of relative strength. This is not the first time or third or fourth or fifth time I see this. I've seen you give kind of a similar presentation over the years at the Harvard Club in the past and at different conferences. But what sort of relative strength are you seeing in today's market? Anything stand out?
I'm glad you brought that up, because I used a lot of examples. The reason I was late, a couple minutes late, is I was having problems with MarketSmith, but I do have sort of a Q charts or whatever you want, e-signal here. I'm finding relative strength. I'll give you one example of something that happened. I'm not recommending to buy this now, but Coherent COHR, when you look at let me see if I can move this over. I don't know how well you see this screen here, but when
you're good.
Okay, when you look at I'll give you a couple ETFs, and I'm sorry, I'm just trying to find the drop. Oh, here it is. Draw the line. When you look at early last year when the market got hit, this is another example of it was not only not getting hit. In January, February of 2016, COHR went from 60 to 80 when everything was getting annihilated. And this was an example. It's a stock that I did trade. I wish I still held it, but this is an example of after the market bottomed in February, March of last year, it just went on for a double. And so that was just a recent example. I will use two really quick ones because I'm glad you brought this up. SMH Semiconductors, let's go with a daily chart here of the semiconductors, and around the election here, it held up extremely, extremely well. When the market, sorry, I'm not used to this drawing on this, so let me just pull up, give me 1 second. Around the election, when the market was drifting and we had those down days around the election, it held up very, very well. It also held up very, very well around Brexit. SMH. That's why I've been tweeting out. I'm a growth manager, and semiconductors continue to show up on my screens. All the monsters, Nvidia and
Fahmy, go back to like a year plus the weekly chart or a longer term chart.
Yeah.
So look how the market, the S&P 500, the Dow, all of them in January of 2016, all put in lower lows, and look at semiconductors putting in a higher low.
Right there, right?
I mean, is that not so beautiful?
Yeah. No, you're right. It put in a higher low, and then in Brexit, what I really like is the recovery after Brexit on higher volume. It sort of goes down on high volume here, but then trumps it on bigger volume and was the first to emerge to new highs before the S&P did. So this is a sector, if you talk about, I mean, COHR was just a specific stock that came to mind, but this is a sector that you're absolutely right, made a higher low back in the early 16, and after Brexit was one of the first sectors to go to new highs. During the election, October, November of last year, held up very, very well. Now, on the flip side, talk about relative weakness, is I know a lot of people are obsessed with biotech. I have nothing wrong with biotech. I did really, really well a few years back on it. But, when you look at a daily chart, and I'm not saying to short it or anything like that, I'm just saying essentially since the election here, since we gapped up since the election, biotech hasn't really gone anywhere. So that's an example of the opposite of relative strength, where a lot of sectors and materials and all semiconductors and even the FANG stocks, whatever growth, they've all recovered pretty well, and biotech has struggled for obvious reasons, the political headwinds, and two, leaders of past cycles tend not to be leaders of the newer cycles. So, those are two examples of semis showing incredible relative strength and biotech showing weaker relative strength.
I love it. Fahmy, where people are interested in getting a copy of your slides, how can they do that?
My email's there. They can email me. I think you're also archiving this as well, right? But if they want to email me, I'd be happy to send them the PDF of the slides.
Great, and send it to me too, Joe, please.
Yeah, okay. That's no problem.
And if people are interested, right? So Joe Fahmy, manages money for investors. If people are interested in giving you money to manage, how do they contact you? What's that process look like?
Yeah, no, I appreciate you bringing that up. They can email me. We manage money for high net worth individuals and institutions, both taxable and IRA money. We do it through managed accounts, so clients have complete visibility, control of their accounts. They're custodied interactive brokers, and it's worked out well. I've met some great people through my blog, through seminars and so forth, where they basically. A lot of people, this goes back to my point about taking time. A lot of people really are passionate about the markets, but I find 90% of the people in the community have full-time jobs. There are people who trade full-time, and they are passionate about the markets. They just don't have the time to put into it, and would rather have a professional do it for them. So we've done well over the past few years. I'm very pleased. We're coming off of a very strong year last year. And a lot of people, for example, will leave their job and have an old 401k and roll it over into an IRA, but they need some help with it because they're moving to a new job or a startup. And that's where I believe it's a full-time job, and that's why people hire me, to do my best in good markets to take advantage of these types of stocks, because I do believe you can trade individual names and do better than the market. And also in corrective markets to reduce exposure. There's a big argument about passive versus active investing, and my answer to that is everyone wants the best of both worlds. So when the market's going up, they want to be passive, and when the market's going down, they wish they were a little more active and raise some cash. So
human beings. We're such terrible investors, Joe.
Well, that's why. I'm not opposed. I'm not bashing passive. I believe there's room for passive, but as part of an overall portfolio, there's also room for active. Why be average? This whole world is just wussification of the world. Everyone's just going average. I'm not saying to hire a manager. I'm saying even do it on your own. Pick some stocks, live a little bit. There's some great opportunities, and Howard Lindson's talked about this, that not only can change your year, it can change your life. Imagine if you bought Monster Energy in 2003. You're a gazillionaire. That changes your life. But if you're just in the index, you suffer through 10 years of nothing. So
Joe, you're the one who taught me that if you trade the averages, you get average returns.
there you go.
I mean, that was great. I love it. I think about that constantly when I'm looking at S&Ps.
You want to be. I'm not going through life being average. You want to be average, fine. Just buy the S&P and go to sleep. But that's just. I'm saying live a little. It's fascinating if you're really passionate about this. It is fascinating to try to find stocks and try to find the next Microsofts and the next McDonald's and study the big winners of the past. And instead of the old Home Depots and Walmarts, maybe find the next new retailers, or the old Microsoft software companies. Let's find, the next new software companies. And to me, I love it. I screen the market every night. I'm looking at 500 to 800 stocks. I'm very, very, very passionate about trying to find these types of winners and using some of these relative strength techniques.
And guys, I can attest. Joe and I will sit there, crushing sushi for an hour, and we'll be arguing about emerging markets for 90% of that. So, we can't help ourselves, right? I mean, it's just what it is. But listen, Joe, I want to thank you for coming today. I think your presentation was killer. Not a surprise. Everybody seems to have really enjoyed it. I know I personally did. So it really does mean a lot that you came here today. So thank you.
No, thanks for having me, and I really appreciate everyone for tuning in. Again, you can email me if you want the slides, and thanks for putting this together, JC. It means a lot, and it's a big compliment to you, the people who've committed to this, and it's a big compliment to the people listening, looking to improve themselves, and I applaud you guys for that.
Thanks, Joe. Appreciate it. I'm going to bring in